Welcome back, everyone, to Vox Markets. My name is Paul and I'm delighted again to host this Easter stock picking extravaganza with three of the finest investors in the UK, namely Jack Brumby at Stockopedia, David Thornton of Growth Company Investor, and John Hugham of Invest-ability and former editor at the Investors Chronicle. So welcome, gents.
Hi.
Well, it's a great round table this morning. Now, Jack, can we kick off with you? Because it's been pretty tough sledging on the markets over the last 3 months, not least because of the Ukraine-Russia crisis and rising inflation and central bank tightening, to name just a few. But equally, stock valuations have also compressed dramatically over that period. So just broadly, what's your sort of outlook for equities going forward?
I concur with the idea that it's been difficult for quite a few people out there, but what we're also seeing is quite a dispersion in outcomes. So anyone that's kind of looked to the indexes and seen that it's not quite mirrored their performance, you know, there is that dispersion going on. So yeah, it's an interesting time. There's headwinds and risks as there always are, maybe more so now than other times in the past. But I think, you know, one of the best things you can do is to just keep investing in quality companies. I think things at reasonable valuations as well. You're right about the valuation compression, and there are reasons you could anticipate that to continue with certain highly rated quality stocks, with things like interest rates coming back and inflation, you know, in full gale. So I'm looking for kind of good margins and pricing power, really. But there's also, you know, I think there's a contrarian angle to it all, where it feels like anecdotally quite a few people are fed up with their heads down, and I think it is a good time to be on the lookout for opportunities.
Well, you sound a bit like Warren Buffett-esque there, Jack. So I'm looking forward to hearing sort of like some of your cracking stock ideas. Now, if just turning to John, I noticed you're quite sort of interested in a recently listed IPO, LBG Media, which I understand is a youth sort of like digital publishing platform that listed and raised over about 110 million, I think it was, just before Christmas at £1.75. The shares haven't largely moved, but just want to take us through that one, because that seems like a really interesting stock that's just sort of quietly crept onto the markets, other than the sort of like the hawk-like view of or sight of yourself.
Yeah, absolutely. I mean, you know, as you say, it's focused on a youth audience. So I'm not the target audience, as you can probably guess, but I like the business. I started looking at a number of IPOs that have come onto the market last year, and to see sort of what characteristics of those IPOs actually sort of seem to influence their subsequent performance. And I looked at another one called Victorian Plumbing, which you may know. And I noticed
slightly different businesses, I guess.
Very different business, but it was more the characteristics of what they were intending to achieve by coming to market that I was looking at. And Victorian Plumbing seemed to be very much a case of the founders, you know, cashing in. And that's what I wrote, and the shares have done really very badly ever since. But LBG, I quite like the look of it. It's in that sort of hot spot of you know, really generating a lot of customer data in a very valuable audience segment, as you say, the sort of the youth demographic. And it seemed to me that they were raising money for the right reasons, which was to keep growing this business, to expand it into the US, to keep monetizing this content that it produces, which is incredibly popular. I mean, it
owns its own websites, doesn't it? It's like Lad Bible, is it, and stuff like that.
That's right. Yes, it's got Lad Bible, Sports Bible. There's a thing called Unilad. There's a female-oriented site called Tyler. And it also distributes content through social media platforms.
So it's first party data, isn't it? Which is crucial because of the trackies. The cookies have been stopped tracking on Apple iPhones, for starters.
Yeah, it's exactly. But you know, it's working on, you know, it monetizes content through Facebook, through YouTube, and it's working obviously with, you know, any of these social media platforms like TikTok, for example, or Instagram, which don't currently offer monetization. So there are big opportunities here for this company. Big opportunity to expand internationally. The US is going to add a fair old chunk to revenues as it starts to grow there. And as I say, I just like the fact that it came to market with a growth strategy in mind. It's quite illiquid, so it's only about 30% in public hands, 30% free floats. That's probably why the shares haven't done a lot. It's got some results out in a couple of weeks, but the trading update was fantastically strong. So yeah, it's one that I'm keeping a close eye on. I think.
We'll have a good look at that one, no doubt about it. Now, just turning to other tech stocks, David. I understand KAPE has caught your eye, which is sort of like a good high growth at a reasonable price type, sort of like cybersecurity and VPN stock. Do you want to take us through that? Because it's quite a big business, actually, isn't it?
Well, yeah, it is. I mean, just picking up on what Jack said at the start. I mean, I'm very reluctant to take any valuation risk at the moment. I don't really want to own any stocks with a PE that starts with a 2, to be honest, which can...
What, 200?
But well, those as well. But I equally, I don't want to get too mired in, sort of low growth, mature businesses. So finding good quality growth companies on modest ratings is usually a good way to make money. And I mean, KAPE, I've followed it from about 60 or 70p when it was Crossrider. I first wrote about it in GCI, and at that time it had basically legacy cash from a discontinued business. And I met the CEO Ido Ehrlichman, who's a very driven former investment banker. And his task was to put that cash to work. And, here we are at a 1.3 billion market cap now. And he's obviously raised some stock along the way. But, the shares have done extremely well. But still,
what are its USPs? Just briefly.
Its main business now is it's business to consumer, and it's VPN is the main. I mean, they have other related sort of personal computing and cybersecurity products, but the main service is.
So that's pretty big in Russia and China, I guess.
Yeah, I mean, if you want to watch the BBC when you're on holiday on you need a VPN and it's security on public networks and so on. So it's a sort of thing which, you think is a good idea. You sign up to, and hopefully you keep that direct debit going, and they have a pretty good retention rate, sort of in the low 70% region. They've recently.
Who do they compete against?
NordVPN, I think, is one of the largest ones. They trade the brand CyberGhost, and they recently bought, which is a big deal for them, Express VPN, which is more premium priced service based in the States. So, I mean, the trick here has been to find good acquisitions at a reasonable price, typically the owners coming on board, staying with the businesses, and then basically bringing them together on a common tech platform, generating synergies and so on.
Great.
And the growth has been excellent. I mean, it's now obviously at a size where incremental deals are probably not going to have quite the same impact on the growth numbers, but I mean, it's still going to be growing around a sort of mid-teens clip in terms of earnings, maybe a little bit more in the near term as they drive.
Well, that means its PEG ratio is less than 1, because I get it.
It's 13 times.
It's slightly less than 13.
Doesn't pay a dividend. It is quite indebted at the moment, but it generates a lot of cash. I mean, for example, forecast for leverage ratio this year end is 1.9 times, and that drops to 0.8 times in 23. Yeah, okay. So it by 24 it'll be net cash.
Yeah. Just turning now to another stock that you had, John, in your portfolio, just on the on AB Dynamics. Now, this is an interesting one because I've never really looked at it, but again, £250 million market cap, and it's sort of an expert in all things automotive testing and systems, particularly sort of autonomous driving, I guess, going forward.
Yeah, this is one we looked at on the Invest-ability podcast in one of our deep dives. Now, you'd think it's got everything. It's in the, you'd think it would be in the sweet spot of the automotive industry, as you say. It's got this big automotive testing side of things, very, very focused on safety, the transition to EVs and autonomous vehicles. So yeah, you'd think it was in the sweet spot of where that industry is going. But it's, you know, share price performance recently has been pretty dismal. You know, it sort of had a bounce after the pandemic began, and it's kind of back where it started, which may be explained by some of the supply chain pressures in that industry. So yeah, it's really, I mean, I think it's a struggling business at the moment. The growth rates are not particularly fantastic. Yeah, and you're being asked to pay a high price for that. But there's something that's sort of niggling me, that, you know, maybe this is one that to keep on the watch list, because, you know, as I say, it's in the sweet spot. You know, it's going to be coming from a sort of low base of returns and you know, margins, return on capital, that sort of stuff. Not particularly attractive at the moment, particularly with the rating. But
well, I think this will basically come along such that. Sorry about that. I think this will have like a vaccine moment, I think, in terms of, you know, basically, as soon as somebody develops an autonomous driving system, maybe, you know, Tesla or something like that, then all of a sudden it just becomes such an important product to have, isn't it, in testing?
Well, sorry, I got in. I mean, I visited them a few years ago, and actually I was sat in the back of a car being autonomous driven around an airfield in Wiltshire. And the shares, I mean, you know, and it's a great story. Your point about Tesla is that they produce a test equipment that the R&D labs of Ford, VW, and so on buy to develop their end products. And the stock went absolutely bonkers in this sort of 18-19 period, and got onto P on a 40-50 times. And as John said, I mean, it's been dismal for the last couple of years. They've made quite a few acquisitions. So I think a new management, new CEO came in, and they made some acquisitions scale up. So I'm not quite sure how those are working out. But I mean, this is my point earlier about valuation risk. I mean, they're still on, looking at forecasts here, 29 times this year, falling to 24 times. And the stock has more than halved from its high, which shows you what a valuation basis it had previously got onto. And I think there are a lot of names still around here which, on the face of it, gosh, it's come down a long way and it's a good company, but is still on a, you know, a pretty demanding valuation.
Well, it sounds
I'd 100% agree with that. That's exactly the way I'm looking at it. You know, it feels like it's in the right place, but it's got a lot to live up to, and it's not really showing the signs of doing that right now. But it's one to keep on a watch list for sure.
It will be on mine. That'll definitely happen. Now, Jack, just turn into a stock that actually is not usually considered as tech, but falls into the industrial tech, is Volex, which seems to have sort of like metamorphosized from the straight sort of cables, electronic cables and connectors business into supplying sort of like these solutions into sort of healthcare and into data centers and stuff like that. And the shares are really cheap. They're on about 11.7 times PER.
Yeah, so exactly. The story with Volex, we've written about it a couple of times, and I think the story is like out there for small cap investors, private investors now. But just a brief kind of run through is it was a more commodity type cabling business. It had customer concentration. It was heavily exposed to Apple. There was competitive pressure, margin pressure, and it was in a very tough spot. Then Nat Rothschild and Co. came in to manage it. He's got a 25% stake thereabouts, and they kind of initiated a turnaround, and it's now firmly back in growth. And they've really kind of struck upon quite a solid, proven strategy now. It's exposed to 3 growth areas, still cabling, but it's higher up the value chain, and it's increasing vertical integration and scale. So good things happening with the margins there. But the areas there, they're EVs, medical, and data centers. So they're all quite strongly growing areas. And the reason I bring it up now is because the shares have come down from, I think it's 496p back in late 2021 to about 250p. So it's more or less halved in, you know, the wider market tantrum. So I think that makes it interesting again. Yeah, so it's and also recently, so it's acquiring companies, and it's shown quite good discipline there. It's buying sort of between 5 to 7 times EBITDA, these companies, and more recently it's been getting a couple of defense sector cabling groups. So that's like sticky revenue, is quite critical. So it's developing. It's quite a strong business, I think, that's happening there, and I would sort of back it to continue executing via acquisitions, internal growth investment, you'll see the margins continue to improve and the valuation has come right down.
Yeah, I know Judith McKenzie likes this one as well, so you're in good company. Now, David, just turned into a really fast-growing B2B fintech e-payments and forex business that I know quite well. It's called EQLS. In a nutshell, what attracts you to this one?
Gosh, I mean, it should have done about 50 or 60 times earnings with that with that intro, but it isn't, which is, I suppose, what attracts me.
Yeah,
I followed this. It's another one I followed for quite a long time when it was Fair FX, and yeah, I've met Ian Strafford Smith quite a few times, the CEO, and it basically it's got a little bit of a checkered past because it overpromised, and like a lot of smaller growth companies, it just took a lot longer and a bit more money to get to where they wanted to be. So it had quite a setback in share price terms 2 or 3 years ago, but it's very clearly on the road to recovery now. It's got an extremely good chart, very close to an all-time high, which, as we know, in small cap growth space is actually telling you something, because most of its peers are well off their highs. Its background was in foreign exchange cards and so on, particularly for consumers, but it's moved away to focus much more on the corporate sector, SMEs particularly, providing them with very easy.
It's bank grade forex payments, isn't it?
Yeah, exactly. To do cross-border payments, FX payments, and so on. Tech interfaces and other, that they provide cards as well for staff and so on. So lots, quite a range of banking services. They're not a bank though, because they don't have a banking license. They don't take deposits, but they are acting as a credit broker in terms of helping arrange loans for customers. But it's they've got to a point now where the customer growth and the scale that they're achieving is taking them firmly to profitability. They've done most of the investment on I think pretty much all the investment on the tech platform and the systems. They're putting more money at the moment into sales and customer support because they're getting a lot of traction in terms of gaining new customers, growing very strongly on that front.
Yeah, well, I did see their prelims. Their sales were up sort of like 50-60% like for like in the
I mean, talking to Ian, he's saying I think the average number of products per customer is like 1.1 or something. So he's got there's quite a lot of scope, I think, to farm the existing customer base, as well as grow really strongly. And just looking at the valuation, I mean, it's on 19 times, I think, this year, but falling to 14 times next. So again, very strong growth and a pretty modest rating for it. And the shares trading, very nice uptrend, trading quite close to the high. It's one which it's taken a while to come good. But I think they're finally getting there, and that's getting recognition. Yeah. But on that valuation, I think it makes a lot of sense to me.
Well, I hope you're right, because I own shares in EQLS. I declare that one. Now, John, just turned into a small cap stock, actually, which well, I wouldn't say that's small. It's sort of like $340 million. Is Somero Enterprises, which is actually on a PE ratio of less than 10. So this is sort of like a growth at a ridiculously low price, I guess.
Yeah, I mean, the PE rating, it does seem, absurdly low, given the quality of the company. I mean, it's, what it does, it essentially creates machinery for creating perfectly flat concrete floors, which is extremely dull sounding, but extremely important. So basically what that is, most important for is modern warehousing, where you've got your enormous racks and, what do they call them? Hydraulic forklifts, that kind of thing. The floors have got to be perfectly flat. And this is what is driving a lot of growth at this company, what with this sort of e-commerce supply chains, and also the kind of the reshoring of supply chains. You've got this whole move from just in time to just in case. So a lot of warehousing coming much closer to the kind of places where the manufacturing or distribution is happening. So yeah, I really like the company. It develops, and I actually own it. I'll better declare that now. But yeah, I mean, it's continually developing new products, pumping a lot of money back into expanding its what it sells, expanding its capacity, particularly in the US, which is, as you would expect, a very, very significant market for it. It's brought its sales operation in Australasia under direct control, so big growth opportunity there. And I mean, it's as you say, just seems absurdly cheap, paying a big fat dividend as well.
Would somebody buy this? Because I mean, it makes 55% gross margins, which says it's actually got quite a lot of IPR.
Yeah, I mean, it really does, and that is perhaps one of the things that investors might hope for. That actually one of the big equipment companies comes along and says, yeah, we'll have that. I mean, I guess that the reason why the shares are cheap is because construction is inherently cyclical. And if we are facing a serious recession, and we've seen sort of signs in the market that may be the case, then construction may be hit. So yeah, there is. I
can't see online warehouses and sheds being hit. That's for sure. That's a secular growth trend. So
yeah, well, exactly. But I just think it's the construction side of things.
Yeah,
that exposed to construction, which gives those cyclical worries, which essentially means that the price, the rating is discounted, despite the massive growth on offer, despite the fact that as you say, it has all this IPR and could well be a takeover target. I really like this company. So yeah.
That's why you own the shares, I guess.
Indeed.
Okay. Now, Jack just turned into. I think the stock he did mention last time is Macfarlane, which does supplier of sort of cardboard packaging and self-adhesive labels. That is really sort of, I guess, is playing a bit on the sort of the ongoing health of the consumer and direct to consumer online deliveries.
Yeah, e-commerce definitely plays a role there. It's actually just got rid of its labels business, so you're left with a more streamlined kind of enterprise there. But Macfarlane is a fairly simple, boring pitch. It's just you've got a below market valuation for above market growth and quality, really, and it's just quite neglected. Headquartered up in Glasgow, it's quite a de-risked strategy. It's all Macfarlane needs to do to grow is to continue doing what it has done for quite a long time. And that's organic growth investment and smaller bolt-on acquisitions. It's got a very developed acquisition team and criteria, so it knows what it's doing there. Revenue and profits have been growing steadily over the past 10 years. And operating margins have been increasing as the company scales. So or becomes bigger.
Yeah, I did see the EBIT margins are high single digits, aren't they? Which for this type of business says that they're doing something right. You get an economies of scale or something like that happening.
Yeah. Well, the nuance here is it's not in the wider, more commoditized packaging market. It's in a niche subsector where it competes on value rather than price, and it interacts with its clients a lot more. And it's got, I forget the name, but it's some six criteria checklist of how it kind of identifies hidden costs for its client companies and how it can save them quite a lot of money that way. So it's good at what it does, and it's the UK market leader. It's got about a 20% share there, and it's looking to expand into Europe just by following its existing customer base, which seems quite sensible to me. And if you think packaging kind of is proportionate to GDP, that would suggest the market in Europe is 5.5 times the size of the UK. So there's a growth opportunity there. But the good thing about Macfarlane is it's an eminently conservative and prudent company in the guidance it gives out, and the brokers even explicitly acknowledge that as well. So you won't find any acquisitions modeled into forecasts, even though Macfarlane's own guidance is to do sort of two small bolt-on acquisitions per year. And
it does seem to be a good sort of like, steady low risk type of 11 times, 12 times PER thing. If people want to go for a low beta stock in the small cap arena, that's the sort of fits in with your strategy as you talked about, sort of like good upside, but less potential downside as well, I imagine.
I actually had a look at some of the bigger paper and packaging producers like Mondi and DS Smith. And one of my big concerns about that, Jack, you might have a view on this, is how are they managing the sort of input cost inflation and passing that on to their customers, who you'd imagine are sort of fairly big buyers and might resist them.
Yeah, so that's why Macfarlane competes on value, not price, and I think that's an important distinction. I think it does have some pricing power. It does keep notifying people about the cost input, the inflation and things, but so far it's been managed very well by management, and they're confident of continuing to navigate those waters. It's not easy by any stretch, but it's a good team there, and so far they've been able to do it.
Good. Okay, well, moving to similar place, well, a sort of different place, but in that sort of whole supply chain delivery, we come to David, Kitwave, which again, I think IPO'd sometime last year, quite quietly. It's a wholesaler of sort of impulse products to local convenience stores, I think. So I don't know if we're talking about sort of ice creams and chocolate and fags.
Yeah,
and
I prefer to call them staples.
Oh, okay, sorry.
Because that implies what I think the stock is, which is a very lowly valued, very low risk business. So you're right, it did IPO last year, but it was actually founded, I think, in 1987 by the current CEO. So there's lots of experience there.
It competes against Booker's, doesn't it? Or Booker's
it's a small. Absolutely. I mean, it's a smaller version of there are two Booker's, which is owned by Tesco.
Yeah, so nobody's going to use it other than Tesco stores.
Yeah, and I'm trying to remember the name of the other.
It's okay. That's all right.
But yeah, I mean, there are two big companies, and they've got thousands of customers, which are your corner store types. Yeah. They're also trying to grow up in food service to small independent restaurants.
Well, selling hot chickens and burgers and stuff.
Well, yeah, I mean, selling the stuff that goes to the kitchen of the pub where you have your fish and chips or your steak pie and so on. Now that part of the business is a higher margin because it's chilled, and they've got national food chilled distribution, which is high value. But basically, what it is 30. I think it's 30,000 customers, fleet of trucks. Delivering on a daily basis, very reliable, and also, very short order cycles. So inflation is not an issue for them. Everything just gets passed straight through to the customers. So you're safe on that. You're safe on the demand side.
It sounds as though it's sort of like a key linchpin for sort of like vital infrastructure, particularly when it's tested during the pandemic.
You could regard it almost as a utility for local food retail.
And on a 10 times PE ratio, you're not paying much for it, are you?
Well, you're paying. On the numbers I'm looking at, I mean, its perspective is 8.5 times.
Okay, well, even better then.
A 5% yield, and I do like a yield at the moment. I like being paid up front in these uncertain times. They're acquisitive. There's lots of sort of smaller regional companies for which they know backwards because they've been in the industry for forever. I think the latest company they bought down in the West Country, they've been courting the management, the owners there for about 3 or 4 years before they acquired them. So you'll get some acquisition, and it generates cash like crazy, as we'd imagine the distributor. So you're going to get sort of Xing out the impact of inflation. In the old world, you'd be getting sort of 4% per annum sort of organic growth, plus your 5% yield, which is taking you to close to a 10% return. Yeah. Plus hopefully 3-4% from acquisitions, and you're not really paying very much at all for that.
Yeah, it looks like,
and it's very, very safe. I think very reliable.
So yeah, it does look like an orphans and widows type stock. Now, something with a bit more sort of beta. We talk about reopening plays here, and I know John sort of likes this area. He's got JD, Wetherspoon, and Jet2 and Shoezone. And do you want to Jet2 came out with a pretty good statement this morning. Actually, shares are up 5%, saying they're seeing monster levels of bookings, which probably actually plays well to equals actually there, David. But anyway, we go on the reopening plays, John. If you take us through Wetherspoon and Jet2 and Shoezone.
Yeah, well, I'll start with Jet2 because, as you say, they had some numbers this morning which look pretty good. I mean, it's unsurprising that they're seeing strong demand because everyone's been essentially locked up in the UK for a couple of years and is desperate to go on holiday. And this is essentially what the story is here. I mean, the thing that's held them back has been sort of uncertainty over COVID restrictions, which have now, from a UK perspective, at least, all gone. It's the big cost for a business like this, obviously fuel, which has been a worry in the last sort of couple of months since the Ukraine conflict broke out, but it's well hedged on that side of things. And I think we looked at this investability quite a while back, and our view was that actually, when you've got a situation like this where an industry's essentially been brought to a standstill, you're gonna see people, you're gonna see losers and winners, this looks like it's going to be one of the winners. Regardless of the temporary hiatus in trading, this company's well cashed up. And it has very good relationships with hotel groups, and has a very good strategy in terms of how it treats its customers. It's really prompt to refund customers who'd booked and saw their holidays cancelled during the pandemic. So it has very, very good will within its market, a very, very good reputation, it's expanding its fleet of planes as well. So this is a company that's been investing into weakness, as it were, and looks like it's going to come out stronger the other side. So
I must admit, data points. The people I'm speaking to are having 3 holidays this year abroad, so not just the one summer one. So I think they're going to have to double that fleet of planes.
Well, I mean, they essentially are. That's the plan. But this is a good growth story and recovery story at the same time.
Yeah, and now Wetherspoon, I'm guessing, because we're all going to be heading to the pub when it comes to the World Cup again at the end of this year. This one's going to have a monster November and December, isn't it? All the pubs are going to be packed again.
I'm not sure about Wetherspoon, and I put it in there as just it's really a discussion point.
Okay.
Because its shares are they've come off a lot. It's really struggled through the pandemic, and it had some numbers sort of a few weeks back, and it's still struggling. It's still struggling, and so by comparison, we're seeing companies like Revolution Bars, who are kind of back where they were before the pandemic. Wetherspoon is still significantly below its pre-pandemic sales.
So why aren't you raising a glass to it then?
Well, I mean, the shares are quite expensive still in terms of the level of earnings.
The beer's cheap though.
But the beer is cheap, so that might actually stand it in good stead during a period of consumer belt tightening, which I actually believe we're likely to see. But again, it faces that inflationary pressure, both costs in terms of the cost of beer, the cost of food, wages. I think it's still in a tough spot, this one. So I think I pulled it out as a point of discussion as to not all recoveries, not all reopening trades are going to be made equal, as it were.
Okay.
I think Wetherspoon's going to struggle for a bit longer.
Okay, well, before we sort of move on to Shoezone, actually, Jack, could you take us through Vertu Motors? Because this one, again, is synonymous with the consumer, and it's done pretty well, and it's a good sort of steady eddy with real estate, but it's a motor retailer, and the order books for cars are still pretty long, I think.
Yeah, so I think John was touching on some interesting points there. Like the point on sectors, like if you get sectors that might suffer or the outlook's cloudy, I think it always pays to consider what are the quality operators within that sector, because these market depending on your time horizon, the market shakeouts generally are good for the good operators, because it leaves them with more market share to grow into. But that said, Vertu, it is a tricky one insofar as car dealers are low margin. This is consumer discretionary. I have a lot of empathy with the cost of living issues at the moment. So it's not all sunny skies there, but you're right that this incredible windfall conditions we're seeing so far are continuing. And I've got it in because I feel like the stock market is almost fixated with this one-off period, and there's a bit of share price volatility there based on kind of news flow of backlogs, and is it a bit down, is it a bit up? But you look at the valuation, and it's what, 3.7 times this year's earnings and rising to 8 times next year's earnings. So that's still pretty cheap. And there's been multiple upgrades for FY23, and once it's got all this kind of cash flowing through onto the balance sheet, I've got net asset value at about 70p per share, and you're not looking even at the ancillary businesses there. So
one of its peers was taken out, wasn't it, just recently?
Yes, yeah, exactly. So Marshall Motors was acquired, and I just think there's good value there.
Yeah, no, I mean, let's be clear about it. You know, you might have had a pandemic where people have wanted cars, but frankly, there's no chips to make cars. And so consequently, there's still a lot of people who haven't been able to receive the ones that they ordered 2 years ago. Not that I've been trying to get a Fiesta at all, but hey ho, wait and see. Now, getting a box of shoes, John, in terms of Shoezone, is this up for discussion, or is this something you like? I mean, I'm guessing with the China lockdowns in Shanghai, it's difficult getting your Clarks over to your shops in the UK.
Well, it's not going to be helpful. I mean, I think the supply chain crisis that we've seen is continuing. I think that those pressures are real, and they're not going to go away anytime soon.
Particularly from product from China, I guess.
Yeah, and you're seeing a lot of companies who are actually shifting production, well, slowly from China. I mean, Dr. Martens is one that we looked at, and they're actually looking at other manufacturing bases. But yeah, so that is something to be mindful of, and obviously, shoes don't make themselves. They require commodities to actually produce the things. But in terms of the quality operator in a sector, I mean, Shoezone, it's not Prada, it's not Jimmy Choo, but in terms of the way it runs the business, it is a quality operator. Okay. It's retail, so you're not seeing the super high returns on capital, super high margins, but they run this business very, very tightly. It's kind of family held. Always like to see that. And their property strategy is fantastic. They have their properties are on very, very short leases. Gives them massive flexibility, gives them the option to close stores that aren't making enough money, and then shift into this big box format, which is proving transformational to this business. So I mean, it's a slow grower, but it's I think this is a steady eddy in the retail space, and it's just one that's it's kind of safety first in retail, and there's not much of that. Cut its dividend during the pandemic, but that looks like it's on the way back as trading improves as well. So yeah, I like this one.
Good. And then David, just on I tip my hat actually, because you've made some pretty good tips in the oil and gas with Gulf, Keystone, and independent O&G. Do you want to take us through those, because they've been terrific recommendations?
Well, yeah. I mean, I'll start by saying that I'm not don't consider myself remotely an expert in the resources.
Well, I wish I wasn't an expert and made that kind of money.
It's not an area of the market historically I particularly liked, but I do think now is the time to seriously have a decent amount of exposure. And I think when we last spoke back in December, one of the stocks I spoke about was BlackRock World Mining Trust, which felt like a bit of a cop out in a small cap forum, but it was something I felt strongly about, and I think it's up about 40% since we spoke. And I do like resources, and it's just obviously the oil price is riding high. Who knows where it goes? But it's just the valuation on these two names and a lot of the other junior producers. I mean, these are not speculative companies in terms of being explorers, drilling holes in the ground and hoping to find something. They're producers, and they just look to me to be anomalously cheap if commodity prices and the oil price stays up at high levels for a while. I mean, Gulf Keystone operates in Kurdistan.
Yeah, I was going to ask about this. How do you actually decide, when you just brought a picture in this area, about geographical exposure? Because obviously Kurdistan in Iran or Iraq has got history of sort of difficulties.
Big difference between Iran and Iraq. So
Iraq, but Iraq, and then you've got sort of independent, which is in the UK sort of stuff. How do you sort of balance that out, and also sort of like put in the relevant risk?
Well, I think the interesting thing premiums about Gulf Keystone is that you're right. I mean, it obviously it is a tricky part of the world, and they have had a patchy record in being paid by the Kurdistan regional government in the past, and who have been in arrears. But they've now been receiving monthly payments, and the arrears are now down, that they're owed, and now down to $17 million, which is pretty modest in the context of the company. The key thing is that they're sitting at the moment on effectively 66p a share of cash in the context of about a £2.30 to £2.40 share price. They generated that's 180 million of cash. They generated 120 million of cash, free cash flow last year. and their operating expenses are less than $3 a barrel. You've got substantial production. You've got some modest production growth this year. You've also got a longer-term growth prospect from a further field development. But the key thing is they recognise that they're in Kurdistan, a tricky part of the world. So that cash flow is flowing back to shareholders. Now we had a 17p dividend in February. They've declared another what equates to another $90 million, which is 31p to come in the next 3 months or so. So you add that together, and if you bought them at the beginning of the year, you're sitting on if you bought them at the beginning of the year share price, you're sitting on a 25% yield. On 6 months. And given the amount of cash flow being generated, it's just going to keep hosing you down with money, which I rather like at the moment. As I say, it's I'm getting a lot of my initial investment back very quickly, and that offsets the risk of being in that in that region. IOG doesn't have a political risk.
It's in the UK, isn't it?
It's UK North Sea, and they've just transitioned from being a developer into a producer. They just delivered the first gas into obviously a wild UK gas market. I mean, if you look back over the last 10 years, UK gas prices have averaged between 20 and 40p a therm. I mean, it's base line. It's been as high as 400 in recent weeks. I think the average for January was something like 205 a therm. So they're producing gas into an amazing market, and because they're a new producer, they're completely unhedged. They will be putting hedges in as they get a sense of the stability of production and so on. And there has been a hiccup with one of the producing wells, which has just had a little bit of a hiccup, and hopefully won't take too long to fix. But if you look at the numbers on this one, they should do around about £200 million in EBITDA this year's latest forecast, which puts them on 1.3 times EV/EBITDA. There's 60 million of debt, I think. So that's going to disappear pretty quickly. There's further CapEx because they're going to be expanding, hopefully further in the field that they're in. So production should be rising. It just looks way too cheap. And even if gas prices halve, they're still going to be generating oodles of cash.
I mean, both of those
cheap.
Yeah, both of those look sort of licensed to print money, don't they? Now, just moving into sort of the agricultural, the soft commodities play, is Wynnstay, Jack. I know you mentioned this briefly last time. Now, it's sort of like is a supplier of all things agricultural feed and fertilizer, I think, to farmers and stuff like that. And farming has actually been it's quite a difficult place, because if you're in the right spots, food prices have gone up, which is great. But if you're sort of like a pig farmer, abattoirs have been struggling to actually get enough labour into, to be able to service those. So they seem to have a sort of like quite a different, or sort of say bifurcation of different sort of farming between arable and livestock.
Yeah, definitely. And Wynnstay, to its credit, has spent quite a lot of time building out quite a balanced business with exposure to different parts of the market. I bring Wynnstay up again because it's just a neglected stock. It's it started off as a cooperative of Welsh farmers, and you can feel that spirit still there. So I try to bang the drum for Wynnstay a little bit. But I think it's just an interesting company because you look at the low margins. I think that clearly stands out, but this is an absolute unit margin business. So I think that's a differentiator in an inflationary environment. I think if you look at the cash generation over time and the dividend track record over time, those are really good indicators that this is actually a very robust business. And it's a business where things like the weather can have a big impact in the short term. That will obviously balances out over the long term. But so I could see I could see the argument for why you might want to time your entry here. So for that reason, I'd flag it as a watch list stock right now. But I personally hold, and I'm relatively sanguine about short-term volatility. I think the idea that it'll stay range bound between like 300 and 600p is probably incorrect, because if you look at what it's doing, it is growing. Just it's, again, kind of like Macfarlane, a relatively de-risked strategy of just really owning its market, growing organically, making smaller bolt-ons. It's got sort of half of the UK to still expand into. So yeah, just steady Eddie.
Good. And then John, another one which you've got in sort of like the small cap area is XB Factory, which is a formerly Escape Hunt, I think, and bought a business called Boom Battle Bars, which is a bit of a mouthful, but I haven't actually been there throwing axes, but I understand it's pretty popular down the East End.
Absolutely, yeah.
Where the craze used to be, I think.
My manor.
Or
no,
Peaky Blinders.
That's your manor.
Yes.
No, I mean, this was brought to my attention the other day, not because I've really looked at this company much before, but I met somebody, a really kind of serious entrepreneur, and he's obsessed with escape rooms. And, he's done 35 and counting. And I kind of started thinking about it, and was thinking, look, and especially in the context of what I was talking about in terms of Wetherspoon. Having been locked down for 2 years, and I suspect many people spent those 2 years sitting at home, really, probably, having a few bottles of wine most days. Do people really want to go out and sit in a pub and drink bottles of wine, which is what they were doing at home? And actually, I think there might be a shift that's going to take place in the sort of going out market towards a more sort of experiential approach. And Escape Hunt, is in the sweet spot of that. It's, as you say, there's sort of a range of entertainment type evenings out. Had some numbers from Hollywood Bowl this morning as an example of that. Again, absolutely fantastic. It's that experiential thing, potentially family oriented as well. I mean, it's still on the cusp of profitability, XP Factory, but it's getting there. It's sort of turning EBITDA. Obviously, got absolutely annihilated during lockdown. Revenues sort of disappeared entirely, but they're bouncing back very strongly. Trading update at the end of January shows massive growth over 2019, particularly on the site level EBITDA. So yeah, I kind of just think it's worth keeping an eye on. And as it sort of shifts towards profitability, as it expands both in the UK through its own operated sites and through franchises overseas, I think there might be something here. So again, it's not one I own yet. It's not one I'd recommend right now, but it's definitely one that's worth keeping an eye on.
Good. And then just moving down to sort of like property and investment related. Jack, the property franchise business, which I think was the old Hunters business, wasn't it? Was it a reverse takeover or something like lettings and sales? You still, I mean, given where the housing market, you keep hearing house prices are up double digits from the Nationwide and from Halifax this week, and there seems to be a shortage of supply of housing stock onto the market. Too many buyers, 30 odd, people looking around houses and they're snapped up within 24 hours, that kind of stuff. Is that sort of the play is continuous on that theme?
I think so for now. It's definitely an interesting period in the housing market, systemically important, I would say, and that's probably reflected in government actions over lockdown. I remember I was writing about it just as lockdowns were starting, and some people were worried about how these companies were going to do. And TPFG, you can also probably substitute this almost like for like with Belvoir. Winkworth's a bit smaller, but these franchise-led real estate business models, I think that's a structural growth opportunity away from market factors. But anyway, if you had kind of gone out of the share then, the stock's doubled since then, and the results going forwards are very good. It's across both rental and sales. So rents are up about 6 to 8% across the board, and that's obviously a very different kind of cash flow stream to the transactional market. But transactions are very strong, and you're right, there was the Hunters acquisition, which looks very well timed looking back, because that boosted TPFG's sales as a part of the whole. So yeah, I just say you look at the valuation. The shares are doing very well right now, but it's, that franchise model really does lead to high returns on capital, and I think it can continue to take share in quite a big market. The valuation is still just not very demanding. Obviously, the huge elephant in the room is reversal of QE, rising interest rates.
Yeah.
What happens if the wheels come off? But again, to that point about good operators, even in struggling markets, it depends on your time horizon. That could all play out, but I would back TPFG to survive that situation and come out the other side and grow over a longer time frame.
Another two, sort of like being back, David, on the real estate investors and also Gresham House. Obviously, Gresham House being a fund manager and real estate investors being around my neck of the woods as well. So like commercial property, I understand, mailbox and that kind of stuff. So do you want to give us a quick whistle top of the both of those?
Yeah, sure. I mean, real estate investors I've followed for a couple of years now, and it's done pretty well for me, but it's still very, very cheap. It's West Midlands based commercial property investor. Small lot sizes, and it's not really much of a developer. It's basically a rent collector.
Yeah.
Small lot sizes. Paul Bassey, the CEO, he owns a chunk of it, and he's tells me that the market is very, very buoyant. There's a lot of demand, particularly from the high net worths and so on, who quite like to add a bit of commercial property to their portfolio. So smaller lot sizes are very well bid at the moment, and I get the impression that true valuations based on those transactions are meaningfully below the valuation that is currently in the
Birmingham's
in the
doing very
accounts.
well because of HS2, actually.
I mean, he mentions HS2, Commonwealth Games. There's all, and it's a regional market, and he's also not in city centre offices. He's in the sort of regional or suburban offices and so on. It's a much more sort of stable market.
I see the shares are 40p and it's got a net asset value of nearly 60, hasn't it? So
yeah,
it's
the
obviously...
NAV's 59, as I said. I think that's probably understated. So it's on a 30 odd discount to the NAV. It's an 8% yield as well. He's been a net seller into this market strength. So the loan to value ratio is down near sort of 40% or so. And he recognises the fact that this is really a subscale business. There's a lot of value on the table, and it would not surprise me to see some sort of value realisation event at some point.
So it'll be
you're getting paid. You're basically getting paid 8% while you wait, and at some point we might see a 35% sort of uplift to the capital value as and when it gets sold or wound down or whatever. So it just sits nicely in that sort of low risk value basket.
And another consolidated sector is obviously that fund manager with lots of other fund managers being taken off. With Gresham House, it was one you quite like as well, and they've got a good stable of.
What I like about this one, I mean, I'm a bit, I'm not exactly enamored with the stock market at the moment. I'm a bit nervous, like most people, and I think the nice thing about Gresham House is that it's really focused on alternatives. Biggest part of its portfolio is forestry, which has been a very big asset class in the States as an alternative for decades, but is still relatively new here. And I think it's over 40% of their assets are in forestry, but they're pretty much focused entirely on alternatives, which continue to be well demanded by institutional investors, ESG sort of angle as well. The platform's got critical mass now. They've got enough assets on the platform, so there's organic growth. There's also sort of bolt-on acquisitions of small teams or small bits of business. He bought a VCT business from another firm fairly recently. It's Tony Dalwood who runs it. It's growing very nicely, sort of mid-teens clip. It's on about a mid-teens PE now. It's actually just made an all-time high. Again, I quite like quite interesting companies making all-time highs in this market. So I think it's not quite as cheap as it was a couple of months ago, but it's not bad value on about 50 multiple, growing mid-teens, maybe a little bit better than that if they do some good deals. operational gearing, obviously, as you grow AUM on the platform, and it's not correlated with, it's a fund manager which is not correlated with the equity market. So you're not quite you're not quite on the same roller coaster ride you are with, say, Polar Capital, with the, so tech market does this and that. So even though that looks a cheap stock, this I think is, it's well worth having a look at.
Yeah, and there's massive consolidation in this area. I mean, River and Mercantile got taken out just recently, so yeah, I mean, it could easily be sort of bought off. It's quite interesting actually, because we entered we started off with Jack. You're saying that obviously we've got to be a bit cautious, but we've just run through about 20 stocks. And there's terrific value there. I mean, if you actually you do the average of all the PEs, I don't know where you come to, but you've probably got less than 10. So I think that says actually maybe for people who have got long-term time horizons and prepared to take a bit of short-term volatility, there are actually a lot of really good opportunities if you're prepared to dip your toe into the water. So big thanks, gents, for all those excellent, or should we say cracking, because it is Easter, stock ideas, and looking forward to again touching base in 3 months' time. So well done, guys.
Thanks, Paul.
Thanks, Paul.
Thanks, Paul.
Cheers.
Cheers. Thanks a lot.